have with us today Steve Lerch, who is the Executive Director of the Economic and Revenue Forecast Council, as I think you all know, and I think you're also familiar with his very extensive background as an economist and a researcher. We are very fortunate to have him here, despite the fact that he's delivering bad news and that he delivered yesterday, so don't give the messenger a bad time for that. And let us all welcome Steve Lerch.
Thank you. Okay, I'm glad you turned the lights down because now if I have anything, like salad stuck in my teeth, you can't see it, which is awesome. Okay, so, and I don't know how you want to do questions, but I'm happy to have you interrupt me with questions, so if anything comes up. Basically, yesterday we presented our February forecast. The last one we did was in November. And what we have seen since November is a little bit of a deterioration in the U.S. economy, in the global economy, and those are reflected in a slightly weaker Washington economic and revenue forecast. If you read, the Fed released the minutes from their meetings yesterday. Obviously, they're a bit concerned. As recently as January, we thought the Fed would be raising interest rates 4 times this year. Our most recent forecast assumes they will now be raising rates twice this year, and even that may be optimistic. Clearly, the Fed was a bit concerned about the state of the economy. I'll talk about some of these forecast risks. The bottom line for the general fund state revenue forecast, this biennium it's down about 67 million. Next biennium, and this is more of a problem, especially for the budget outlook, it is down 442 million. So, I mean, despite the fact that this is, we're seeing less growth, there's certainly the potential for some upside here. We could, we've seen some growth in wages. I'll talk a little bit about that. We've seen the unemployment rate come down. There's certainly a lot of room for more residential construction. I think if you look at construction activity now compared to before the recession, if you look at what's going on in house prices and rents, so there's certainly some potential for upside there in our forecast. And while not for everybody, but for most businesses and for virtually every consumer, lower oil and gas prices are good news. On the downside, we have, as I said, seen the U.S. and the global economy slow. For a state that's very exposed to international trade, that's a big deal for us. The stronger dollar, it's good news if you're buying imported goods. It's great if you're going to Europe this summer, but it's not so great if you're trying to sell your Washington products overseas, so that's an issue. And we've seen weaker manufacturing activity, likely in general tied to the fact that the export, market has been tough. So, we've seen this is national, this is average monthly employment growth, Washington and the U.S. over the last few years. Last couple of years have been pretty good. 2015, not quite as strong as 2014. We've got January U.S. employment, kind of a disappointment. Still, not a bad number. But, you can see well down from where we've been. We don't have final Washington numbers for January. We think they'll be pretty good. But, I mentioned wage growth. So we finally have seen, and this is inflation-adjusted wages, we've seen wages pop back up, kind of hovering around 2% the last several months. This is national data. That's good news. Means that consumers have a bit more money to spend, but we're not seeing the sort of, acceleration that you typically see in wages sometime after the end of a recession. So we're seeing some wage growth, certainly some room for that to grow as well, so that could be an upside to our forecast. And I mentioned housing, so this is looking at Washington and U.S. Residential housing permits, single and multifamily. Washington definitely, and the U.S. definitely seen some growth since 2011, but there's definitely some upside room there as well. I will say, as you'll see, we did slightly reduce our forecast of residential construction in Washington in this forecast, though. Okay, so this is looking at global GDP growth. I'm using International Monetary Fund's forecast. We don't do a forecast of this. They do one every quarter, and if you look at the last several quarters, every quarter you look at the IMF forecast, it's coming down. So we've definitely seen some weakening in global GDP growth. Obviously, that means that the people in China, in Canada, in Japan, and other parts of the world that Washington businesses are selling goods and services to have less money than we thought they were going to. So that's not so good. And as we mentioned, the dollar has gotten a lot stronger. And so that just means that U.S. products, Washington products, are more expensive overseas than they were a year, year and a half ago. And those things, and there's some issues with the port slowdown in there too, but what we saw last year, and this is merchandise, not services, but merchandise exports coming out of Washington declined in 2015 for the first time since 2009. That global GDP slowdown, the stronger dollar, I think, has contributed a lot to this. And I mentioned manufacturing, so this is a survey-based index of manufacturing firms, asking them a variety of questions about their hiring and investment plans, their order books. And you see for the US, it's dropped below 50. In other words, manufacturing activity has been contracting the last few months. Washington was below 50 and it's now bounced back up. But manufacturing has been, especially nationally, pretty weak. Okay, so turn to our forecast. This is looking at GDP growth in our February forecast compared to November. And what you can see is a little bit weaker in 2015. The first estimate for fourth quarter GDP growth, 0.7% for fourth quarter of last year. We had thought that would be considerably higher in November. And so 2015 actuals we think will come in a little bit lower than where we thought they were in November. We have reduced 2016, 17, and 18 GDP forecasts as well a little bit. Not huge amounts, but cumulatively these are going to add up. So a little bit weaker U.S. economic growth. Mentioned oil prices, big dip in oil prices. We've given up on forecasting oil prices. So we use futures prices. Whenever we do a forecast, we force the oil price forecast to be what the futures market says it will be. Obviously, in November, the futures market thought oil prices would be higher than, in fact, they turned out to be. So, it's not like the financial markets can't be wrong, but we find that to be as good a forecast as any. But this big dip in oil prices has done a couple things. One, it's had a real negative impact on inflation. Inflation is lower. When we do a revenue forecast, it is a nominal current dollar forecast. In other words, lower inflation, that means lower growth in personal income, that means lower growth in sales tax and B&O. And then in particular, lower oil and gas prices mean lower gross receipts from refineries, from gas stations, so that means that in particular those B&O collection sources are going to be weaker. So I think this is really good news. As I said, if you're a consumer, cheaper gas, that's great. You've got more money to spend. What we've seen is consumers have been spending some of that money, but they've also been using some of that money to pay down debt and to save. So it isn't necessarily turning into growth in retail sales. This is our Washington State personal income forecast. Again, those international and national slowdowns in the economy flow through to Washington. The lower inflation plays here too. So the slowdown here in personal income is about half inflation. In other words, pretty big decline in inflation since November, and about half an actual decline in purchasing power. So a little bit weaker income in terms of people's ability to go out and buy stuff, but also a little bit lower because of inflation. by the time you get out to 2019, about 1.7% lower than what we thought in November. So it's not a huge change, although that's, you know, a lot of money. And I would point out that, excuse me, somewhat consistent with that change, that 442 million decline in the general fund state revenue for next biennium, while I know that's a huge amount of money for budget writers, that is about a 1.1% decline in general fund state revenue. So it's certainly in keeping with what we're seeing here with what we think is going to happen with the economy. A little bit lower housing permit forecast. Again, the construction sector has a sort of an overweight, if you will, in terms of the general fund. It has a big impact on general fund collections. So a little bit of a slowdown in residential activity. We have also revised down our non-residential activity forecast a little bit, and so that also is going to have a negative impact on our collections. This is our major tax sources, our Revenue Act sources, so sales, B&O, use tax, public utility tax. Big spike in August, very strong, way too strong to persist, and it hasn't. So you see that, you know, collections have sort of started to flatten out a little bit more typical year-over-year growth pattern. And, you know, I think that's a really important point, that when we have reduced the revenue forecast here, we are not saying the state's going into recession, the state's not growing, that revenue sources aren't growing. We're going to continue to see growth in sales tax and B&O, just a little bit slower than what we thought in November. Another thing that seems to have weakened a little bit is the real estate excise tax. We had seen a very strong third quarter, fourth quarter of last year. Both commercial sales and residential sales were a bit weaker. Big commercial sales have really been booming, especially in the Seattle metro area, but there is a limit to how many times those buildings are going to turn over. A lot of that is institutional investor money. There's huge interest among pension funds, sovereign wealth funds, in real estate assets in the Seattle metro area, but we do think that those big transactions are going to start to slow down. So we anticipate that real estate excise tax collections will slow a little bit as well. Okay, always have to mention marijuana. So the green line is, this is not dollars, but this is grams of smokable marijuana. So the green, which is on the left axis there, yeah, you know, when I went to graduate school in economics, I never thought this is what I was going to be talking about. But, you know, whatever. You know, take your laugh lines where you get them. You know. So that scale on that side of the graph, that is monthly sales in grams of smokable marijuana. So when I used this the other day, somebody said, "You mean every month somebody is smoking 4 million grams of marijuana in this state?" And I said, "I don't know. They're buying them. I don't know." No, this is only smokable, because the edibles, it's really hard to put those into consistent units, if you will. So, I mean, we count the money, believe me, but just for graphical purposes, what we really wanted to look at here was what was the impact of legalization in Oregon, which started in October. So the axis on your right is Clark County sales across the river from Portland. That's the blue line. And that big dip you see, that's October. That's when recreational sales started in Oregon. And what we see is a big decline in sales in Clark County, another dip in November. And the combination of those in November meant that for the first time since July of 2014, there was an actual decline in sales of smokable marijuana in Washington State. Now, if you look at December and then January data, what we see is sales starting to head back up a little bit, which is interesting because starting in January, Oregon imposed a 25% tax. So October, November, December, There was no tax on recreational marijuana in Oregon. As of January 4th, there's a 25% tax. So really, the full impact of what's going on in Oregon, I think, is still a bit unclear. And this is even before they license any recreational stores. Right now, they have limited sales of smokable marijuana only through their dispensaries. They're in the process of licensing recreational stores. So it's still going to be a while before we get a full sense of the Oregon impact.
I don't suppose, Steve, that there's any way to know, is this over and above the black market? Or do we know whether the black market has been sold?
We don't know that. I will tell you that based on, so after Initiative 502 passed, the Liquor and Cannabis Board, hired a group of drug policy consultants who sort of collectively went under the name BOTEC. They did an estimate of statewide marijuana consumption. Now, it's an estimate, and of course it was based on asking people about illegal activity, but based on that, we're around 25%. Our recreational sales are about 25% of what they thought was the entire Washington State marijuana market. So the rest would be medical, and so the rest is medical and black market. July 1st, medical and recreational get combined, and so we'll see, we assume, another increase in cannabis revenues then, because right now medical marijuana is not subject to that 37% tax that the recreational cannabis is. So we do think, we are making an assumption that it has cut into black market sales. Prices are now down pretty close to the best of our knowledge, black market prices. So including that 37% tax, if you go into a recreational store, the average price is around $10 a gram. Black market prices are probably in the $8.50 range, according to the folks who talk to people about that sort of thing at a website called priceofweed.com. So I mentioned to people that, you know, at work I get to go to that website and not get in trouble, but I don't know if you guys do. I think most employers would go, anyway. So this is a really interesting, this is tough for us to forecast. We don't have anything that approximates any kind of steady state equilibrium, whatever you want to say, because this has been constantly changing. So here's a point I wanted to make, relative to the forecast change. Yeah, we have not had the revenue forecast go down. The last time it went down was before I started working here, and I've had this job for 4 years. Time flies when revenues are going up. I think things are going to slow down now. But what that green line represents is the historic relationship between our major tax sources, between the growth in our major tax sources and growth in state personal income. Historically, what we've seen is that those Revenue Act tax sources have grown a little bit slower than personal income growth. Now, what you see is kind of, for the last several years, for the most part, we have been above that. Revenues have been growing relative to personal income faster than that historical average. As we feed in the new data into our model, including slower international and slower U.S. economic activity, what you see is the model's wanting to push that relationship back towards the average. That is what econometric models tend to do, is they're looking for average relationships. And so that's where the forecast is headed here towards the end of the forecast period, is kind of heading back down towards sort of a more typical relationship. So again, we are reducing the revenue forecast, but that doesn't mean revenues aren't growing. It's a little bit slower growth than what we thought in November. Okay, so that's the change in general fund state for this biennium, $67 million. One of the questions that came up yesterday is, wait a second, aren't your current collections, money in the door, isn't that above where you thought you'd be in November? And the answer to that is yes. And the next question was then, why is the revenue forecast going down? And the answer to that is right now we are above where we thought we'd be in November because of a couple of one-time things. A particularly large audit payment that we don't see happening again. We've had some above average collections in unclaimed property, again, that we believe are kind of one-time things. And we are above where we thought we would be in terms of penalty and interest payments. So in terms of the things that we think will carry forward, we are consistent with the slowdown in the state's economy that we're forecasting, a little bit of a slowdown in revenue collections as well. The much uglier number, that's next biennium, 442 million decline. As I said, yes, that is a very large number, and for budget writers, that is a problem, and it's a problem for dealing with the four-year budget outlook, but that is about a 1.1% decline in general fund state revenue for next biennium, and that puts us, another way to put this in context, if you were to look at our revenue forecast a year ago, so February of last year, this is 40 million, not 40 billion, 40 million below where we thought we would be for next biennium a year ago. So these are the growth rates that come out of this forecast. And for those of you who follow the four-year budget outlook, when you have revenue growth in the next 2 years that's below 4.5% for budget outlook purposes, it is assumed to grow at 4.5%. So you can see that in fiscal 19, we're below that 4.5%. So when the budget outlook is calculated based on the supplemental that the legislature passes, then they will assume a 4.5% growth for revenues for budget outlook purposes for that year. Okay, so happy to answer any questions, but basically we're looking at a little bit slower economy than we saw in November. We continue to believe that Washington will do a bit better than the U.S. economy. We are not calling for a recession. We are calling for a little bit slower growth. We're still seeing, growth in revenues. So this biennium, about 10.3% higher than last biennium. Next biennium, about 8% higher than this biennium in this forecast. We still see lots of uncertainty. There's lots of risks, we think, to this forecast. It's a tough time to, maybe it's always a tough time to do economic forecasts, but there's just a lot of churning going on. So we do think that there's a fair amount of uncertainty in this forecast. And with that, I'd be happy to try to answer any questions. So 2 weeks ago when we did our preliminary economic forecast, I had some slides that more directly address that. So you're right. We have a forecast that now goes out to 2021. For okay. Would you like to be on the council? I need some more people that are more agreeable. We're not assuming a recession out to 2021. That would be really, really, really the longest economic expansion ever. That would be 150 months. The longest post-World War II is 120 months. And so I think you might rightly say, what, are you crazy? But a couple things to think about. First of all, if you think about that 150-month of expansion, if we say we get all the way out to 2021 with no recession, well, in that so-called economic expansion, you have a lot of very, very weak economic activity. Remember, officially, for those of you who go out to the National Bureau of Economic Research website where they have the official beginning and end dates of all the recessions going back to the 1850s, the recession ended officially in June of 2009. Now, if you followed Washington employment after that, what you'd see is it went down for several months. We didn't get back in this state, we didn't get back to pre-recession employment, nationally, we didn't get back to pre-recession employment until early 2014. So some of this super long expansion has not been very expansionary. And I think if you judge the expansion based on when you got back nationally to pre-recession employment, what we're talking about is very consistent with a very strong, one of the longer but not the longest economic expansions. So that's one. The other is to assume a recession. I have to tell you why. I have to give you a story. What's the trigger? You know, economists like to say economic expansions don't die of old age. There has to be a reason. And I've given you a bunch of possible reasons. You know, the global economy could get way worse. The U.S. economy could slow down way more. But we would have to say that's what we think is going to happen and when. And that's really, really hard to do. And so what we're trying to do is a forecast that we think is the most likely path. And we think that trying to forecast what would cause a recession and when it would happen is way, you know, throwing any of that in at any point gives you a path that's way less probable than what we've got here. So that's why I don't think we're going to see a recession. Excuse me. However, we are seeing slower growth. Remarkably well. The two measures have been bouncing around a lot. The two we follow. We follow the Conference Board and University of Michigan. There's a couple others as well. Bloomberg's got one, and there's a few others. And over the last 6-8 months, they've had a tendency to move in opposite directions, but not by a lot. They're generally trending up. And I think the fact that when we see them moving in opposite directions, to me that says, okay, be a little bit cautious. Consumers, depending on the day you ask them, you know, may feel better or worse depending on what news they just got. What did the S&P 500 do today? Oh, what are gas prices doing? Oh, what announcements have you seen in the paper about something bad happening? But I think consumer confidence is really it looks pretty good. Not quite as good. It's certainly up from the recession, but it's tended to sort of move kind of up and down, but I don't think you see a ton of optimism from small businesses. I think there's still a lot, and I think probably a lot of you could speak to this personally way more than I could, obviously, but you know, there seems to be people still are thinking about what happened during the recession. They're very cautious. They see consumers that are being somewhat cautious. And so that has not gone, it's kind of, so. Now, we don't do that, well, okay, take it back. The Forecast Council is responsible for doing this four-year budget outlook, so it has both sides of that. Our office does the revenue piece. There is a work group of which I'm a member, but the people who are really doing the budget side of that would be House, Senate, and OFM fiscal staff, who get together and agree on what are reasonable growth rates for sort of doing this hypothetical, what if this two-year budget was extended 2 more years? And so you're absolutely right. Those lower inflation pressures should mean that there's lower costs for making those, you know, purchases, but we're just kind of, you know, I'm just talking about the one side of this. So, but you're absolutely right. It's those other guys, right? So the structure of the Forecast Council, with a Republican and a Democrat from the House and from the Senate, 2 cabinet members from the governor, you know, the governor's cabinet and the treasurer. The idea was you've got executive branch, legislative branch, both parties. We just do current law forecasts. We don't make any assumptions about what might pass, so that we don't get pulled into any policy discussions, because what we don't want is for people to think that somehow this forecast is tilted in any particular direction, that this is the best forecast we can do, period. And so for that reason, we stay very far away from policy discussions. Once something passes, then we will incorporate it into the forecast. So we haven't done that. I know other folks in the state have, but I know that sounds like a really weaselly answer, but.
Please, thanks.